Good morning and welcome to Bazaar Morning Call. I am Anuj, with me Prashant and Sonia as always, and of course we start a very important and big week. This one, the market is at a very important level. The trend line that we keep talking about, it looked like the market had overcome that, but now back below that. So very important make or break zone. 17,700 is that level, that precise level, the fulcrum of that all important trend line. We'll discuss that. Why is that important? Because this week you have the Fed decision, which is imminent, of course. 75 basis point rate hike is fully in the price, but can there be 100, which is something which the market will debate. And that becomes important because once again you've started to see FI selling, but that on Friday was attributed to rebalancing. So I think today perhaps could be a bit of a test. The SGX Nifty is indicating that we'll have a flat start, and then we'll take it from there. Prashant, Sonia, hi, good morning.
Hi, Anuj. Morning. Welcome back. Prashant, hi, morning. And it's good, right? I mean, the SGX Nifty is suggesting a pause. That's, I think, the best case scenario. People don't want to retreat, perhaps. So that's the big question. What happens this week? It's an all-important week, not just the US Fed meeting that begins tomorrow and then we'll get to know on Wednesday. But there's also the Bank of Japan rate decision that takes place. So in that context, a lot of important central banks across the world are meeting this week. And in all likelihood, there will be rate hikes across the board. So we'll have to negotiate that as well. The Dow was down quite a bit, but in our own markets as well, right? Both foreign and domestic investors have now turned sellers. So there's a point of caution there. FI sold to the tune of almost 3,300 crores. There was small selling by DIs, but selling nevertheless. The Nifty was down almost 2% last week. There were huge cuts on large technology stocks. So there is, of course, caution ahead of the Fed decision. The 20-day moving average is what the Nifty slipped below. So the 20-day DMA is 17,680. The question we're asking this week is, will the Nifty continue to trend lower, or will it just take a bit of a breather before that big event and just wait for that event to move out of the way? That's the million-dollar question, right? I mean, generally, if you go by history, then global events like this have not rattled Indian markets too much. Do you think this time around things could be different?
Well, let's wait for the market to answer that, Sonia. But, you know, Friday's bar is very big, the red bar. And, the way market effortlessly took out Tuesday's low and closed at where it is, I think I don't believe this SGX Nifty rate. Normally, I say that on the upside. Today, my sense is perhaps the market has one leg of downside left in it. Remember, on Friday low was 17,497 thereabouts, below 17,500. I think we perhaps, my sense is, go below that, even if the market has to recover after that. Having said that, India is a market which has outperformed despite the last week's decline. And last 2 days in particular, the market declined quite a bit. So today's market becomes very important to track in terms of the texture, whether that buy on dip texture is still intact. The Nifty is trading below all the near-term momentum indicators, the 5-day, 10-day and the 20-day exponential moving average. It's trading below that. So the all-important support now is at the 50-day simple moving average and 50-day exponential moving average. What's that zone? That zone is 17,190, 17,300. And that is a make or break zone for the market. And I think the key for that is on the Bank Nifty, because that's been a very strong index. Even in the downside, as you saw on Friday, it was down 1%, while the Nifty was down 2%. So it's still trading between the 5 and 10-day exponential moving average. So still a bit stretched. But if it, sort of goes towards say 40,400, I think that's where traders may want to explore some long positions. But if it closes below 4,400, I think that's when you will revisit what's happening to the Bank Nifty. And why is Bank Nifty important? Because we know that one pocket of the market, which is Nifty IT, is firmly in a bear market. I mean, there will be tactical rallies in between, like we saw last week, but all those rallies are selling opportunities. That index is now within 2% of 52-week low. So the medium-term focus really has to be on the economy-facing stocks. Look at that, Nifty IT, 1 month 11%, and the Nifty Bank is up 2.8%. Now, in between, you'll have rallies, which you can play and should play, but the larger trend of IT is down, banks is up. I think that's the trade which might continue up until the year end or so. Prashant, hi. All-important Fed meet, right?
Finally, all-important Fed meet. So, yeah, 75, as you said, is perhaps in the price. Absolutely, it's been fully priced now. And the Fed is most likely going to sound hawkish. The messaging is going to be pretty hawkish. The dot plots in terms of where the Fed expects rates to be, that perhaps will move higher. And, expect... So last week, if you remember, the big sort of talking point was the consumer price inflation number. That was a defining number, right? The U.S. market fell 4% that day. For the week, U.S. markets were down between 5 and 6%. But, expect the Fed to do nothing, but reiterate unconditionally that their aim is to bring inflation lower, down to that 2% level. So I think that remains very much the case. We are once again in a bit of a risk-off kind of environment globally, a fresh leg. So, as I said, the S&P was down 5, the Nasdaq was down Friday to Friday by 6%. Rates are higher, both nominal and real. So, U.S. nominal 2-year, 5-year, 10-year yields were up 30, 31, 20 and 14 basis points. These are very sharp, large moves. And these are nominal yields, but real yields have also moved up on an average by between 15 and 20%. So things are, on the rates market, there is a fair bit of repricing which is happening. Fed pricing, in terms of what the Fed will do by the end of the year, went up a cumulative 35 basis points last week. So again, important. Commodities are lower by about 2% week on week. This is equities down, yields getting repriced higher, commodities lower. This is a dollar-supportive regime, which is starting to make a bit of a comeback. Mind you, when we get the Fed decision, I've said this before, going into Fed meetings, that day, the decision day, usually the dollar is weak, but that reverses very quickly. So don't take that one-day reaction as, the base case. It's happened so many times in the recent past. We don't have to go very far back. It's all about positioning and, what is in the price and what really comes through and wordplay, all kinds of things. But that's just one day. But this regime is largely dollar positive is basically what I'm getting at. And just look at what the markets have done. Last week, on pretty much any time frame, last week, U.S. was down, as I was saying, 5-6. The market here was up 0.5%. Year to date, the U.S. is down 19%. We are up about 1% or so. This is the larger kind of debate and larger questioning. You can have bouts of outperformance, sure. They can last for weeks on end, sure. But can this go on? Or will there be a bit of mean reversion, which will happen back to what the globe is doing? And that is something we will find out. We got a look at that last week, Thursday and Friday. We'll see if that continues this week as well. Sonia.
Absolutely. And, since we're talking about the big events to watch this week, right, I just wanted to put one more on board. Since you spoke about IT stocks, Accenture will be reporting its earnings on 22nd this week. And generally, Accenture, gives out a guidance for FY23. It's a barometer of any kind of movement in the IT space. So important to see if there is a slowdown in client spends, especially in places like Europe. So in that context as well, it's an important week for the IT space.
Yes, and for IT, Sonia, last quarter was all about margin. All you heard was margin. I think this year you'll hear about top line.
Yes.
And whether top line itself is under pressure because valuation-wise, these stocks, of course, you are hostage to what happened over the last 2 years. So you tend to think that every small dip is buying opportunity. But when the macro event is changing, when there's a bit of a macro reset, then I think you've got to keep an eye on that. And that's what's happening in Infosys. Look at the way Infosys in the last 2 days sort of gave up a rally that it was building for better part of last 1 month. All it's taken is 2 days for all these IT names to give up all the rally that they had for last 1 week or so. So that really remains in a bit of a bear market.
Oh, absolutely. The crucial word is any delay in the decision-making cycle by clients, right? Yeah. Because of the impending recession. We'll track all of that very closely, but let's kickstart the show on that note. On the equities front, first up, we have Mahesh Nandurkar of Jefferies, who says that Jefferies' recovery tracker increased month-on-month in August, reversing the July decline, partly helped by the festive season starting about a fortnight early. He says this improvement is seen across indicators like power and oil consumption, rail freight, auto sales and travel. He adds that there is continued strength in GST, credit growth and housing too. Mahesh says that the Indian economy is holding up much better in the global context, and they are overweight on domestic sectors and underweight on global-facing sectors like IT, metals and energy.
Okay, let's get you some money market views then. Kunal Sudhani of Shinhan Bank says that investors brace for a week covering 13 central bank meetings that are certain to see rates rise across the globe, which includes majors like the Fed, ECB and UK, while Bank of Japan remains the only showing divergence. He adds that the 10-year US Treasury yield still remain on the rise, while US dollar index is seen consolidating. Kunal expects the range for the USD INR 79.55 acting as support, while 79.92 is resistance.
All right, and on the bonds, Ajay Magnolia of GM Financial says the Fed is expected to hike aggressively this week on Wednesday after a cumulative hike of 225 basis points so far. He says that taking cues from the Fed and in order to keep sufficient spreads over the US rates, a policy action may also consider a rate hike next week. Ajay adds that so far the hopes of a bond index inclusion had kept our markets rallying contrary to the global markets, and that has now started fading away as we approach near rate hikes. He expects the old 10-year benchmark bond yield to trade in a range of 7.25 to 7.3 and the new one to trade in the range of 7.2 to 7.25 for the day. Okay, we have plenty of macro cues to track, but you know what, there's a lot of stock-specific action as well. So let's get straight to that. Today, we will talk about our special top 10 segment. We're looking at Ambuja Cements, M&M, ONGC, Inox Wind and Welspun Corp. That's on the radar on the back of positive news flow. There's also Cipla, GAIL, Indraprastha Gas, Mahanagar Gas and Adani Power that are likely to open in the red today.
All right, so that's basically what we have lined up, coming up in just a bit. But let's get the global out of the way. Steve Bryce is Chief Investment Officer at Standard Chartered Wealth Management. Steve, great to have you with us here. Thank you very much for your time. So U.S. markets are down some 18-19% year to date. Here in India, the equity market in local currency terms is up just a bit, 1.5%, but that is still quite a bit of outperformance relative to what the U.S. is doing. Arguably, things here are much better as well. I mean, inflation is not that big a problem. Domestic growth is chugging along quite nicely so far. What's your sense? Can this continue in your opinion?
So I think you're right in terms of the domestic fundamentals. Obviously, the economic performance looks much more robust from what we're seeing from what's going on in India. Earnings growth looks very healthy as well. Obviously, double-digit earnings growth quite comfortably expected over the coming 12 months. And if you're looking at the policy response, obviously there is uncertainty on that regard in India as there is elsewhere in the world. But the market's probably discounted a reasonable amount of tightening still. So from that perspective, we do think that India will be a bit more resilient going forward. So we're within Asia, we're overweight Asia as well. Although to be fair, that's to a significant extent that is a China sort of reflation play that's obviously it's taking longer than we anticipated to come through. But we're overweight Asia, but within that we're also overweight the Indian market as well, based on those factors. It's not going to be smooth sailing. I think we've seen that in recent times. But overall, we're still bullish on the Indian market and expect further outperformance going forward.
Steve, hi, good morning. So the Indian market outperformance, it's already been there, and now we are trading at almost record, premium in terms of the valuations. We always traded at premium, but this is now record premium. So do you guess that could perhaps make the market into a bit of a dangerous territory?
So clearly, it is the sort of the toughest part of the story, if you like, when you're looking forward. I mean, obviously, as you sort of inferred, the market does generally trade at a premium to other markets around the region. But it is very high now, the valuation. So we really do need to see that earnings growth coming through. And if there were disappointments, clearly that would lead to some significant short-term volatility. So the way we're playing this is generally that from a sectoral perspective, we're overweight sort of the more cyclical areas of the market. So we're overweight industrials and consumer discretionary, for instance, where we see the growth drivers as being more significant and more robust going forward.
Steve, hi, good morning. So, it's not just the US Fed, right? I mean, there are a slew of rate meetings that are expected this week. There's the BOE meeting that will take place. It was delayed because of the Queen's funeral. There's also what's happening across the other central banks, whether it's Bank of Japan that meets on Thursday, the Swiss National Bank meets on Thursday as well. And there's a coordinated rate hike that we're expecting across the globe. At a time like this, do you think risky assets like equities would take a back seat? Or are you still bullish overall? Okay, I think we lost that connection with Steve Bryce, but we'll get to that in a bit. He's still bullish on India, so I guess across the board, even if there is a bit of a setback in global equity markets, the Indian markets continue to be quite resilient. But as I was saying, a lot of global central banks will be meeting this week. The Swiss National Bank meets on Thursday. There's a 75 basis points rate hike expected there as well. The Bank of Japan meets on Thursday. There are speculations that the Bank of Japan could be intervening in the foreign exchange market to support the weak yen. So we'll keep that on our radar.
I was reading some 4 or 5 developed central banks are meeting, and in total, including emerging markets, there are 13 central bank decisions. Yeah. So, I mean, it's decision after decision. At least, two a day.
So, and like someone said, right, lather, rinse, repeat in terms of the rate hikes. I mean, we all know what to expect. Okay, let's do one thing. Let's take a quick commercial break on that note. On the other side, our list of top 10 stocks is lined up. Stay tuned. Welcome back. Well, the SGX Nifty for now is indicating that the start will be quiet, and that's good. After all the chaos that we saw last week across most global markets, our market was fairly resilient, but we still saw a deep cut on Friday. Let's see how things shape up. But for today, here are the stocks that you need to watch out for. Anuj, what are you looking out for today?
Sonia, banks again, because, if there's one pocket which really has to participate and take the market higher, it's the banks. 17,500 on the Nifty is a very crucial level, and while we closed above that, the low was below that. So in that sense, keep an eye on names like ICICI Bank and Axis Bank. Axis in particular, because on Friday there was quite a bit of buying in Axis towards the end. ICICI, of course, is in some kind of parabola run, but Axis, the way it rallied on Friday, I think these are the names that I'll keep on my radar. I mean, again, just to reiterate, if the market has to rally, then these stocks got to lead. But let's go across to Nigel then. He's watching out for Ambuja Cement. Nigel?
Well, hi Anuj. Ambuja Cements, the details, have come out with regard to that board meeting. They're going to be doing a preference issue to Harmonia Trade Investments. That's a promoter entity. They're going to issue nearly around 48 crore warrants at a price of around 419 rupees odd. That's a 19% discount in comparison to the last traded price. Remember, since it's a warrant, it can get converted anytime in the next 18 months or so. And, post-conversion, the total amount will be close to 20,000 crore rupees, which is a massive number. Once this is converted, the promoter entity's holding will move to around 70% from around that 63%. They've also changed the accounting, norms out there. Normally, you have a December year-end. Now it's going to be a March year-end. And, as widely speculated, you have Mr. Ajay Kapoor, who comes back at the helm, and they made a couple of management changes as well. The important part, though, is that Mr. Gautam Adani says that they'll be the largest and most efficient company by 2030. On the efficiency front, well, they have got some catch-up because the cost of production for ACC Ambuja is nearly around 200 rupees more than some of its peers. Remember, Ultratech is the big boy in there. They are talking about around 155 million tons of capacity by 2025 odd. So let's see whether or not this is spur inorganic growth. But since there's a commitment of 20,000 crores odd, going with green on Ambuja Cements.
Okay, green on Ambuja Cements. Thanks a lot, Nigel, for that. We're also watching out for M&M this morning. I'm going with green over there. M&M announced that they will be selling a 30% stake in their renewable energy arm for 2,317 crores. Now, the renewable energy arm is called Mahindra Sustain, and they've sold 30% stake to Ontario Teachers Pension Plan Board. As a part of this transaction, the shareholders' loans worth 575 crores by M&M to Sustain will also be repaid. Now, they will look to jointly explore the sale of additional 9.9% stake in Mahindra Sustain by May of 2023. Then they will be setting up an InvIT to list the renewable energy assets. Now, the reason they're looking to do this is to unlock value for shareholders. They announced this in 2020 that in a lot of their arms and their subsidiaries, they will look to eventually unlock value. They will deploy the funds that they raise back into the business and into the InvIT over the next 7 years. And they're looking to build a strong renewable energy business with an operational capacity currently at 1.54 gigawatts. But basically, this measure is to unlock value for shareholders, and I'm going with green on the stock.
All right, that's Mahindra and Mahindra. Now, oil and gas companies are in focus. Mangalam is standing by to tell us why. Mangalam, hi. Morning.
Good morning. So I'm looking at ONGC first up, and that may outperform in today's trading session because of a couple of triggers. The first one is that the government has reduced the windfall tax on crude to rupees 10,500 as against 13,300 per ton. So that's a positive. And additionally, our colleague Timsy has gathered that ONGC has requested the government to actually use the dividend route rather than imposing a windfall gains tax. And if that was to happen, that would be a bit of a positive for ONGC and other players out there as well. And finally, crude has seen a bit of a spike, so that could be a trigger for ONGC. But can't say the same for all the gas companies because India's natural gas consumption has slid about 10% in August year on year. It's about 5.2 billion cubic meters, which compares with about 5.8 billion cubic meters. Import of LNG too has fallen by about 19% due to high prices and limited availability. And average domestic supplies too have dropped. That's because of ONGC's production being cut by almost 5% in August itself. But for these stocks, the important part is how much of that is priced in, because GAIL, IGL and MGL, all of them are down anywhere between 25 to 27% from their highs. So it'll be interesting to see where these guys go.
Okay, Mangalam, thanks a lot for that. So that's on oil and gas, and actually on ONGC. That was something which Naren had referred to before this windfall tax was imposed, because that was always a risk when this ONGC rally was happening. This was 6 months back when that rally was building up. I mean, if you see a slightly longer chart, 3 months, of course, what you're seeing is that windfall tax which was first imposed, which was at 155. But before that, you had seen a decent rally. And then Naren's point was that, instead of extra taxes, the best way would be to ask for higher dividend. That's a win-win. So let's see. But of course, we had the windfall tax, and after that, the stocks, of course, got derated. Let's go across to Ekta then. She's watching out for Cipla. Ekta.
Thanks for that. Well, the reason I'm watching out for Cipla is that it seems as though Nomura has accessed the Form 483, which was issued to Cipla's Goa facility, because they have written on it. They have said that the company was issued 3 repeat observations from the US FDA for their Goa facility. Now, just to give you a background, this particular plant was inspected in August 2022, received 6 observations, and the company at that point had already prepared the market by indicating that there was some reference to observations from a 2019 September inspection, which then eventually turned into a warning letter which was issued to the plant in Feb 2020. Nomura, which has a buy and a target price of 1195 on Cipla, has said as a base case they do not expect the inspection outcome to have a material impact on earnings. They've not factored any material contribution from Abrixon, which is one of the key drugs, a cancer drug, which is filed from this particular facility. So maybe a bit of a negative that we could see on Cipla today.
All right, Ekta, thank you very much for that. More stocks with news flow. Vivek is standing by with that list. Vivek, hi, morning.
Well, good morning. Well, watch out for the Inox GFL group. So Inox Wind and Gujarat Fluorochem, more of a sentimental impact as far as Gujarat Fluorochem is concerned. Inox Wind subsidiary, Inox Green Energy, according to our sources, has got the SEBI nod for launching a significant size offer of close to 740 crore. We understand that this particular IPO will actually be split equally between a fresh issue as well as an OFS. So watch out for some impact on both of these stocks. The other one to keep on your radar is Welspun Corp, a significant order win coming in for the company from USA, and this is for a carbon capture pipeline project, so some green expected there as well. On the other hand, Adani Power, remember the company in July 2020, the shareholders had approved the delisting of the company, but yesterday in an update to the exchanges, the company said that they have decided to withdraw the entire delisting offer. The company did not get approval from the exchanges, and so because it was not commercially viable anymore, the company decided to withdraw the delisting open offer.
All right. Well, thanks a lot for that. So here's a quick recap then of our top stocks. Stocks with positive news flow. There is Ambuja Cements, M&M, ONGC, Inox Wind and Welspun Corp. While stocks with negative news flow today, Cipla, GAIL, Indraprastha Gas, Mahanagar Gas and Adani Power. But we were having a discussion with Steve Bryce, the Chief Investment Officer at Standard Chartered Wealth Management, and he's back now with us. Steve, welcome back to the show. You were telling us how you're overweight on India, but amidst an environment where most global central banks are raising rates, right? There are so many of them meeting this week. Do you think risky assets like equities may take a back seat? And in that context, would it make sense for investors to pause on their on deploying their funds for the moment?
So if we're looking from a global perspective, obviously, the environment is still highly uncertain. I think if we're looking certainly at the macro news flow and the concerns on inflation and central bank policies, clearly there's a significant concern globally about the outlook for economies and whether we're going to see a recession over the coming 12 months. I mean, we've got an assessment that we'll see at least a 50% chance of recession in the US over the coming 12 months. So from that perspective, it is a pretty difficult environment. Now, what we've seen on the from a S&P 500 is obviously we've seen some weakness in recent times coming through. But actually, if you look at the options market volatility, that didn't really spike that much last week, despite obviously that 4% down day that we saw midweek. And also, if you look at the skew of the put to call volatility spread, that is suggesting that actually people are not that concerned. So maybe a lot of the weak hands are already out of the market. So on balance, the news flow is likely to remain negative. Obviously, the FOMC meeting this week is going to be really important. But maybe the markets really needs some really bad news to take another leg lower from here. So maybe just having a decent diversified allocation, adding on weakness is probably the best way for most investors.
Steve, do you think this is, yields are going higher, equities are lower, commodities are lower. This is largely a dollar supportive regime once again. The DXY index has been knocking just at that 110 level, failing to break through it. That's an important channel through which there is, for emerging markets, basically, whether there is a bit of risk on or risk off. What's your sense there? Dollar.
Yeah, so I mean, and actually the causality is two-way as well, because the stronger dollar generally is bad for asset markets, generally, obviously for emerging markets. So you're getting a bit of this feedback loop going. Obviously, at some point, something that can't go on forever will change, but the momentum does seem to be pretty in favor of the dollar. And the last week's inflation print obviously helps support the dollar as well. So over the next 1 to 3 months, the dollar is likely to find good support and track gradually higher. On a longer term basis, we still think the dollar will peak out. But the things in place for that, we need to see the Feds pivot away from this aggressive tightening stance. And then we can see the other central banks around the world continue to tighten to sort of undermine the dollar. But as I say, I don't think we're there yet.
Okay, so you said that it requires some really bad news for the markets to see another leg lower, which means that perhaps we may have, priced in a lot of the bad news already. If that is the case, how do you structure your investments from here on? Is India your most preferred market? What's the pecking order now? And is this a good time to be buying?
Yeah, so what we've been doing so far is generally de-risking our portfolios as we've gone through the year. So we downgraded equities earlier in the year. We've now upgraded investment grade at the cost of high yield in the credit space. We do think this is not the time to be risking everything and putting everything on the line, so not playing the high beta plays. But within that, we do see a different story within Asia. And whereas the central banks are tightening very aggressively, for instance, in the US and in Europe, China, we see them as easing policy and continuing down that easing path that ultimately will support the Chinese stock market and allow it to outperform. And then obviously India, you're looking for areas that have more resilient growth. And India certainly fits into that bucket. So within India, we're overweight financials, industrials, and consumer discretionary, which we think can leverage that growth and be sort of in the pro-cyclical area at a time that globally, actually, that's not a place to be, but maybe for India it is.
All right, Steve, it's a pleasure. Thank you very much for that perspective. Appreciate you joining in us in the program as always. Thanks indeed. Well, Manisha Gupta is now joining in for a roundup of all the action from the commodities space this morning. Oil prices fell about 2% last week, but there's a lot more happening. Manisha is here with that. Manisha, good morning.
Morning, Prashant. Well, absolutely. As you were discussing as well, the major focus point this week clearly is about the U.S. Fed meeting. And ahead of that, most of these markets are choppy. Crude oil prices did see decline in the previous week. Actually, the last 3 weeks have been constant of decline. This week, we're looking at a bit of a gain into the markets as the crude prices take cognizance of the fact that Chinese city of Chengdu is lifting lockdown, and you will see some demand coming back. But the U.S. dollar is firm ahead of the U.S. Fed meeting. The oil and gas rig count in the U.S. has been rising. And all the reports that have come in over the weekend, whether it has been about the Stancy saying that the global oil markets have turned into surplus in Q3, or the MS and UBS reports suggesting that they have slashed the near-term crude forecast on recession fears, could continue to weigh onto the prices. So are we looking at very strong gains from here? Not really, at least until the 21st of September, till the U.S. Fed meeting is out of the way.
Okay, thanks a lot for that. So that is on the entire commodity space. But let's do one thing. Let's take a quick break. We actually had a very interesting and exclusive conversation with Rhythm Desai of Morgan Stanley on the markets. He's extremely bullish here on. Stay tuned for more on that.
Welcome back. Well, the global cues this morning are a bit soft. Our market, of course, has been outperforming, but it's also shown some signs of fatigue. So let's see how the markets open. Well, in our special show, Editors Roundtable, we had a special guest, Ridham Desai, Head of India Equities Research and Strategies at Morgan Stanley. So we quizzed him about a lot of issues. We asked him about India's outperformance and does he expect this trend to continue?
Three very strong fundamental factors. The first is to do with the way the government focused on improving corporate profits. So it started in 2019 when they cut tax rates in September. COVID kind of delayed the effects of that, but we've seen corporate profits boom after that, and there have been several steps that have been taken to boost the share of profits in GDP. And this really comes from the understanding that when profit share in GDP goes up, companies invest, they create jobs, wages go up, and you get all-round prosperity. That cycle breaks when investments get excessive or unproductive, but we are far away from that. So that's the first thing. The second thing is the focus on FDI. So here are the numbers. In the previous cycle, that is the 03-08 cycle, there was about $50 billion that foreign portfolio investors put into the equity markets, and FDI was $40 billion. We were heavily dependent on foreign equity flows. In the last 8 years, FDI has been $550 billion and foreign portfolio equity flows is $45 billion. Okay? So what has that done? That has broken down India's correlations with oil. So notwithstanding the war and the spike in oil prices, India did not behave badly because unlike the past, India didn't depend on portfolio flows which are very sensitive to oil dynamics, unlike FDI. US growth cycles. So even though the US is facing a possible recession, India is not behaving badly. If you look at the last 30 years, all the US recessions have brought deep bear markets into India. This one, I think India will skirt that. Okay. And the third thing it has done is it has actually also, I think, affected the way India is responding to various other global developments. So it's kind of made India more idiosyncratic. I dare say India cannot decouple from the world because we are very big now. We are the 5th or 6th largest market in the world, 5th or 6th largest economy in the world. So we're like a large cap stock in the Nifty. We're not a small cap stock that can do its own jig. So we will be sensitive, but the sensitivities have reduced considerably. So that's the second thing. And the third thing is the the work that has been done on domestic flows. Let's not forget in 2015, for the first time, the government allowed retirement funds to invest in equities. They come every month to buy. Everybody focuses on SIP, but last month ETF flows were 15,000 crores. They're bigger than SIPs. And retirement funds only get net flows, inflows. So they keep buying every month. And this is very similar to the story that happened in the US between 1980 and 2000. Because in 1980, the then administration in the US allowed 401k plans to buy equities for the first time. And you got a secular run on domestic flows in the US. And I think we're in that secular run in India. We're in the 5th or 6th year. We have a long way to go before this thing ends.
Okay. Ridham, every time I see you, you keep getting fitter and fitter. So the market's health, Ridham, considering the points that you just raised, are we now in a market which will just not fall? Peak to trough, we had 18% fall, and then the market moved on. In the last bull market, we had so many instances of 30 or 40% fall. I asked you this question because when FIs are selling, retail really picks up the piece, and after a while, we see FIs buying like gay abandon, like we've seen over the last couple of months. So are we in a market which will just not fall? The kind of fall that we used to have?
No, that's not possible, Anuj. Equity markets are going to fall whenever we least expect them to. And let's keep a note here. We've done nothing in the last 1 year if Nifty is your benchmark. In fact, we're down actually in a year, right? So if you were just buying the index, you've actually made no money. It feels like we're doing very well because a lot of stocks are actually doing a lot. But on average, neither the small cap index nor the Nifty has gone anywhere in a year. So the global bear market has weighed on us, despite the fact that earnings are very strong. We have the strongest earnings in the world, but the markets are actually, they're outperforming, but not actually going up. And they may continue to outperform, but the absolute call still hinges on what the world's largest market does, which is, the SPX. So if the SPX, goes down to what my US strategist thinks is a bear case of 3,100, the Nifty is going to struggle to go up. It will also fall with it, but it will fall less and will outperform as we have done this year. Even that outperformance, I think, is now, at a, extreme point, which may lead to a little bit of a correction even in relative sense. So markets have to go up and down all the time. They can never be, it's not a fixed deposit. You arrive every morning and you put a few basis points on it. Yeah.
Rhythm, you spoke about earnings very strong. But what about valuations? I heard you, in the Chennai conference as well, that don't look at 1 year, 2 year down the line, but look at 4 year point of view, and then India valuations will look cheap. For the larger audience, if you can just explain that thesis on why you feel valuations are not very expensive for India at 20 times forward earnings.
Yeah, so as I was mentioning to Sonia, we are in this big profit cycle, and right now corporate profit share in GDP is 4%. It was at 2% in 2019. It peaked at about 7% in the previous cycle, around 09-10. I think it will probably cross that peak.
Okay.
So probably it's going to go to 8. Even if nominal GDP growth is say 10%, and this journey takes place in the next 4 or 5 years, earnings will compound at over 20-25, around 20-25%.
Correct.
So now if you look forward, because equity markets are forward-looking things, right? And the market gets an idea. It is not stupid, okay? So it knows that there is a, a fair bit of earnings coming through. So a little bit of it is in the price. But if you compound at that rate, then you're trading pretty inexpensive. You look back when you reach 24, 25, and you'll think, oh, I didn't buy stocks in 22 thinking they were expensive, but they were not. This is very similar to the 04-07 cycle. Every time you look back, stocks looked expensive on trailing earnings, but not when you had moved forward in time. So that is the base case scenario.
Is that something which even your FI clients are now looking forward to, and that's the reason why the FI money is back into the Indian markets?
I think foreign... Again, I'm not saying this on behalf of any single individual investor, but on the aggregate, I think they missed the big picture in India. Okay, there was a fair bit of skepticism about whether India had enough policy traction. I think a few mistakes were made, and they overly focused on those mistakes, not understanding that they were mistakes in the context of some very big policy shifts that were happening. Like, for example, GST. So I used to keep arguing with investors on GST that if you think GST is slightly compromised, just imagine taking the 50 states of United States of America and asking them to give up the power to tax forever. Do you think you'll ever achieve that in your lifetime? So if you want to make such seminal policy shifts, you have to compromise a little bit and then work through those over time and see how it has succeeded now. So I think they missed the big picture, and now they're realizing that India is like, the best house in a pretty weak neighborhood.
Rhythm, that point about FII and FDI, that 8-year period that you spoke about, that's very interesting. Could you tell us this $450 or $500 billion in FDI flows? You said that insulates us from a lot of global volatility. I mean, we don't produce the oil that we use. At least we produce about 20% of it. We don't print dollars, right? Could you explain why this $450 or $500 billion, which is coming as FDI, how does that insulate us and put us in a better place? I mean, if you can...
So see, Prashant, FPI flows, which is capital market flows, are a lot more sensitive for short-term movements. So oil goes up $20, they will sell. I'll give you an example. 2008, when the global financial crisis was happening, or I would say Western world financial crisis, India was largely unscathed. Our banking system was fine. Yet that year, India was the second worst performing market in the world in US dollar terms. Why? Because middle of that year, oil went to near $150, and as soon as oil spiked, foreign investors sold. FPI selling in that year was $20 billion. We couldn't absorb that, and the stock markets had to correct. Okay. So that is the problem with FPI in equity, which is that if you're overly dependent on that source as your funding source for your external balances, it's going to be very sensitive to oil, it's going to be sensitive to global events, it's going to be sensitive to US rate cycles. Okay, we're no longer dependent on them. So therefore, look at the change on the macro. The RBI can lag the Fed. That hasn't happened since we opened our doors to foreigners in 1992. We've always had to be a step ahead of the Fed. When we dared lag the Fed like we did in 2013, we got smacked. Okay. Now we can comfortably lag the Fed. We don't have to do what the Fed is doing. So, the Fed may raise by 75 bips, RBI is going to do 50. And it's already done less than what the Fed has done in the last, 3 policy meetings. So that strength has come from the fact that our macro balance sheet no longer depends on volatile capital market flows.
Okay. Is that one reason, Rhythm, that we have seen this rally essentially been about domestic stocks? The bank Nifty is at new all-time high. Auto index is there. FMCG index is there. IT index is in a bear market still. Do you think that this sort of trend will continue then?
So, Anuj, IT depends a lot on global revenues, particularly the US. And if the US is going to go into a recession, then some of those revenues will fade away, and therefore there will be some near-term earnings pressure. So some of that is now, I think, reflected. I would actually be a bit of a contrarian here and start nibbling at the IT stocks, because again, the market is looking forward. So unless this US recession is deep and broad and lasts for a few quarters, I think IT may be now finding a bottom. But if our base case is that this is going to be a short recession, 1 or 2 quarters, not a 4-5 quarter recession. So based on that. But yeah, you're absolutely right. Domestic still looks more exciting. Financials is clearly the place to be. Unambiguously, we are about to enter a loan boom, which will match the pace and scale of the 04-07 era. In the last 4 or 5 years, corporate balance sheets have delevered. Corporate debt to GDP is 46%. I think no large economy in the world has such low levels of corporate debt as India has. And growth is strong. Capacity utilization is rising. So we are set up for a capex boom. Therefore, we are set up for a loan boom. And I think banks' balance sheets look really good. Valuations are inexpensive. So I think you're going to get a ferocious bull market in financials.
Someone's in a really good mood today, I must say. Very, very I think this is the most optimistic I've heard you in a while.
No, I'm always equity markets are only for optimists. If you're a pessimist, go and do something else.
No, but
I'll tell you why.
You have been cautious in the past.
No, I'll be cautious even now, okay, Sonia? So I'll tell you all the pitfalls also of this, and nobody should assume that markets are going to go up. Anuj asked a very good question.
I don't want to hear the pitfalls because
no, I have to say that.
No, you spoke about how you're nibbling into IT. So tell us where else you're nibbling. Pitfalls everyone knows.
So see, Sonia, the stock markets don't do a straight line. Okay, so nobody should assume here that tomorrow morning they're going to go up 1% and then 1%. And if they do that, then they're going to fall precipitously. So the question that Anuj asked is very relevant. But there are a few risks out there. We should not, ignore them. There is a risk that the war in Ukraine continues. It's leading to very high gas prices. Ammonia plants are shutting down. Fertilizer prices are rich. We have doubled our fertilizer subsidy. If fertilizer prices don't come down, it is going to put a burden on India. We have very little appetite to pass them on to farmers. Food is 50% of our CPI basket, so be very wary of that. Hopefully the war ends soon and the effects of the war fade away into 2023. If they don't, then we'll have a challenge. Then we have a US recession. 20% of India's GDP comes from abroad. Okay, so if there is a Western world recession, then we will see a slowdown in export growth, and you can do the math. If exports go from +15 to -15, that's a huge drag on our economy. It will derail job growth. It will create a problem on capital spending. Profits will go down. So it's not all hunky dory.
Optimistic rhythm is now cautiously optimistic.
No. It's not all hunky dory out there. It's essentially a question of time frame.
Yes.
So are you in this for 3 months or are you in this for 5 years? If you're in for 3 months, good luck. Okay, because luck is going to decide what you will do. If you're in for this for 5-7 years, there's a lot of money to be made.
Okay.
I keep telling my colleagues, a lot of us will be retired if we have money in the stock markets, because this will be a massive bull market. There'll be one more caveat that I'll put here, because since we're talking a 5-year time frame, we still have to negotiate 2024 elections.
Okay.
And we're a democracy, nothing can be said until it's done. I think it'll be a very important moment.
That's actually the most bullish I've heard Rhythm Desai in a long time. So on that optimistic note, let's take a quick break. On the other side of the break, we will get Mitesh Thakkar and Sudarshan Sukhani to help us with some trades for the day. Do stay tuned in.
Welcome back. The market for the last couple of days has been showing some signs of fatigue, and while it's been outperforming, it looks like the weight of global cues is just getting a bit too much, even for our market. At least that's what the price sections seem to indicate on Friday. Let's ask our experts if the trend is showing signs of turning. Sudarshan Sukhani and Mitesh Thakkar now joining us. Gentlemen, good morning. Sudarshan, Friday's red bar was quite big. 2% down on the Nifty, and the mid-cap market almost collapsed on Friday. Is this market showing signs of reversal, or is this a market where you still want to explore long positions?
Yeah, good morning, Anuj. No, the markets have changed, sort of their structure just overnight. The first step is that they broke down the Wednesday lows of 17,771. That's a decisive move for the market to make on the downside. I do not think we are now any longer in that original uptrend. Either we are entering a choppy market, or we are probably going through a downside correction. The market will tell us which way it wants to go. But it's not an uptrend. There will be small up moves, of course, that's always possible, but it's not a buying idea now. So there is no buy on dips opportunity in the Nifty. We just wait patiently. Since I'm not a very big fan of going short in the Nifty, so many tests tell us that taking short positions eventually is not a winning proposition. Then it's better to step aside and let the market say whether it wants to go further down or stabilize here. But there's no buying opportunity, not yet. But intraday trades are possible in the bank Nifty if the Nifty shows signs of stability at around 17,500. Then there is an intraday long trade in the bank Nifty which has been outperforming. That's for highly skilled traders. For me and for most others, it's a market where you don't want to buy the dip and just stay away.
Okay, so if the Nifty stabilizes at 17,500, you said perhaps try an intraday long on bank Nifty. What would be the levels to watch on bank Nifty?
No, the levels are for the Nifty because the broader market has to stabilize. But you just keep a 150-point stop if at all you buy the bank Nifty.
Got that point. Mitesh, good morning. How are you trading both Nifty and bank Nifty today?
Good morning, Anuj. See, I think on Friday I said the opening gap down will not be a buying opportunity because the intraday indicators were slightly on the negative side. Also, if you look at the intraday charts of the index, I think we got two highs around 18,050-60 mark. One was on the 13th of September and the other one was on the 14th of September. So we got some sort of a double top pattern, which in the short term indicates that the immediate trend is on the negative side. So again, I think yes, Friday's low is very important. 17,500 is an area which I'm watching very closely. But I think that there is a good chance that we might break it. If not today, maybe tomorrow. But I think eventually we'll go below that. And this correction would get slightly longer. And in the worst case, I'm penciling in about 17,150. Broadly, I think this is a market which I would use if you get a 100-point kind of a gap up, I'll use to buy into put options for the short term. And this correction or this choppiness could possibly continue for about 10 to 12 sessions.
Okay. In terms of stocks then, Mitesh, what are you buying and selling?
So I have more of sell calls, 3 on the sell side, 1 on the buy side. Out of one, the pharma is a sell with a stop at 541, targets of 515 here. Reliance is a sell with a stop at 25.32 for targets of 24.40. Mindtree is a sell on a mild bounce back around 31.30.40 sell with a stop at 31.85 for targets of 30.20. And MFSL is a buy with a stop at 8.11 for targets of 8.45.
Okay, and Sudarshan, how about you? I assume there are more sell calls than buys considering the market momentum. What's your view?
Well, then it's a mix. It's equal, but yes, because the market itself is confusing. Motherson Sumi is an intraday short sell. The stock has been underperforming the Nifty. and it's just broken down from a significant support level. Intraday stop above 130. Muthoot Finance is another short sell, although I did hear that financials will be in a big bull market, but we are only talking of today. And today it's an intraday short, again a strong underperformer with a stop above 1058. Power Grid is a buying opportunity. If we get any dip in the day, it's been an outperformer and is likely to remain so. Buy it with a stop under 233. And IDFC First Bank has been going through a wonderful rally. That rally should continue. Anything that's been going up when the market was going down should be bought into. Keep a stop at 50. So there's a mix and markets are also confusing.
Okay, thanks for that, Sudarshan and Mitesh. Well, let's do one thing. Let's take a quick break. We are just about 5 minutes away from the pre-opening rates, so we'll get to that in a bit. We'll also connect with Ithira Davis of Ujjivan Small Finance Bank as they have raised 475 crore rupees through the QIP route. More on that in a bit.